Ahoy there, trader, and welcome back. This is the Anti-Investor Swing Trading Podcast. Let's talk about what it takes to make swing trading work in the long term. Now, personally, I'm talking from a position of 28 years in the trenches of doing it, and there've been good times and bad times and some absolutely amazing times. And let's not forget the times that we'd rather forget about. But ultimately, there's a lot of lessons to be learned that contribute to success, and I'm looking back on almost 3 decades of trading. There are some things that have been pivotal to still be doing this. I'm very fortunate to be doing this every single day, irrespective of the style of trading, which has evolved for me several times over the years. Around 2001, I started trading full-time, day trading Forex and European futures, typically looking to capture the main swing for the day. By 2005, 2006, I would flip between day trading Forex and stocks and dabbling a little on the US index futures. That then morphed into day trading and short-term swing trading, which lasted for 2 to 3 days, also attempting this time to capture the main swing for the week. Now by 2010, this had once again morphed into swing trading stocks and stock options, as the margin requirements had changed the previous year to be significantly more favourable. It was more advantageous to use options as an alternative to stock. Now, as you might have guessed, the theme once again was to swing trade, but this time now trying to capture the main move for the month. Now, this is when there was a more dramatic shift in my own trading, because I was able to swing trade stocks using stock options as an alternative to stock. It was possible to trade larger portfolio numbers of individual stocks without the huge margin or cash requirements that have been previously associated with stock trading. So this is quite a big and significant change, certainly from my own trading point of view. Now, this is when I realized that one of the main themes in my own trading, which is something that you need to now consider for yourself in your trading. So the big question that I frequently ask and started to ask myself and started to recognize that I was asking this question is, what do you want from your trading? Swing trading in this case. It's a simple question, and before you knee-jerk reactionary answer to me, money's not the answer. Money is a byproduct of process. Or a trading strategy in the case, and it's the same is true of any business. In this case, we just happen to be talking about the business of trading. You need a strategy, you need a process, you need a business plan, in this case a trading plan. Now here's what I realized. Now, all strategies work some of the time and nothing works all of the time. So if you can design a trading strategy around a lifestyle that makes sense for you, it'll make what you're trying to achieve a lot more achievable. So what does life look like for you as a swing trader? Now, what I want from trading has evolved over the years, and how I trade today has, from a strategy point of view, changed very little from how I traded back in the early noughties. Back of the envelope version is what I'm looking to do is to capture the main swing relative to a specific time horizon. I want to get paid at the end of 30, 60 and 90 days. I want to have minimal time at the screen whilst benefiting from the actively engaged in trading the markets. Now, I've developed a strategy, an algorithm, which is a fancy way of saying if this then that type of rules. And this has validated and proven to me that the strategy works. And with that, I now get to choose how I deploy that strategy. I refer to what I do regularly as a production line. You can speed it up or you can slow it down. I like to have that minimal time at the computer whilst benefiting from that maximum activity that we can have. And again, you can slow things down even further, get paid at the end of the month, the end of the quarter, the end of the year, or you can speed things up and go down into the intraday timeframes. It's a versatile algorithm that we can use. Now, I want to spend as little time as possible, as I've just mentioned. I don't want to be flicking through chart after chart after chart like a mindless zombie doing the stock market equivalent of Where's Waldo. A far better way is to click a few buttons and have the computer show me which 2 or 3 stocks that need my attention today from a pre-selected watch list. And maybe there's going to be days where there's nothing to do, and there's going to be days where there's several things to do. you know, it is dependent on market conditions, but quite literally at the click of a button, we can rank and sort all the stocks just like you might do in a spreadsheet. Hey, these are the 2 things that I need to look at today. These are the 3 things that I need to manage today. And because of this strict rule-based structure, the algorithm, it can take as little as 5 minutes if there's nothing to do, and maybe it'll take 20 to 30 minutes a day every other day if there's a little bit of action or activity to do. Now, my point is that my objective is to spend as little time as possible doing this, and that determines how I go about doing it. Now, let's consider an opposing example. Despite spending 12 years day trading and knowing what works, and knowing that it works rather, and it's profitable, I don't want to sit there all day, every day. Now, similarly, if you were to see someone successfully day trading, does it mean that you'll be successful day trading? It doesn't necessarily and automatically mean that, no matter how rule-based the strategy is. Because if you don't have time to day trade, you're not going to be able to day trade. The strategy won't work for you. So this is what I'm alluding to when I'm saying, what do you want from your trading? If you physically can't, or if you're like me, you just don't want to day trade anymore, why are you trying to do it? It's not that it doesn't work. It's just that you can't apply that successful strategy. So back into the time that you have available, or that you just want to commit to trading. Now, this ties into the second big lesson that I've learned that has contributed to my success: consistency. I don't know any more than the next person if the next setup I take will work out the way that I would prefer. All I do know is that I expect it to work on average over multiple occurrences. And as such, I have to take the setups without deviation or hesitation so that there is consistency and I can emulate that theoretical backtest that I was mentioning. The data and historical backtests and research also give me the confidence to place the next trade so I can achieve that consistency. And this next big lesson that I've learned also helps to facilitate this. So another part of this, and all these things interrelate, as you can probably start to gather and appreciate, is the next part of it is to trade small. Trade with a realistic position size. Now, I don't mean to follow what the textbooks say, which is usually to trade 1 to 2% of your available funds per trade. At least not when you start out. There is something far more important that you need to do than is related to your physical per trade risk, the practical cash on hand. And that is to think about and consider, seriously consider for that matter, your emotional per trade risk, or your emotional bank balance. It's a number that's going to allow you to sleep at night. If you're having the sweaty palm experience, the will it work, won't it work, the rabbit in the headlights experience, the basically just some emotional reaction. You know, I've experienced them, you've experienced them, we all experience them at some point. But what we want to do is we want to reduce that position size down so that we can make logical and critical trading choices without having the emotional interference. And there could be lots of reasons why you would also want to trade smaller position size. Maybe you're new. Everything's brand new. There's going to be a learning curve. Other reasons which will help you to keep that position size small is maybe you've been stung one too many times. You've placed too many trades that just haven't worked out because you've not had a consistent methodical process to find, filter and sort stocks. Maybe you've blown up an account one too many times. So that fear is holding you back. So if you reduce your position size to sensible levels, and only you know that number, and it's usually significantly lower than a percentage of your available funds. And also, in learning a new strategy, you will make mistakes. Let's just get it out there right now. You will press the wrong button, you will look at the wrong thing, you will miss the occasional trade. And that's normal when you learn anything. Mistakes will happen. So if you trade small, it minimizes the kicking of yourself when it happens. Again, we've all done it, and mistakes will happen regardless of your experience. It is human. But if you trade small, you're not going to be emotionally and dramatically impacted by any errors that might occur. It also helps to build your own confidence as you learn a new strategy, you learn a new process, as you learn about the charting, the technology and the terminology. It does take a little bit of time. There is a steep learning curve. Just like when you learn anything new, when you learned how to drive, there was a steep learning curve. You had to learn the accelerator, brake, the clutch, the changing of the gears, you've got to rules the road to make sure you don't bump into anyone. There's a steep learning curve, but you come out of it the other side with confidence, with knowledge, with competency. And when you've got that, you can move on to trading consistently. And again, trading small helps to facilitate this. Now, another way that you want to think about this is, what's your number? What is that number that is acceptable to you to risk per trade? It could be $50, it could be $500, it could be $5,000. Everyone has a super small number that they are completely happy with, that's acceptable. Again, you can increase it over time, but you want to start small for lots of reasons, and not just what the textbooks tell us to trade, which is, usually 1 to 2%. So just put that aside for one moment and focus on your emotional bank balance first. Build that up, and then the practicalities can catch up. I've also learned that it's nothing to do with your net worth. I've seen grown-ass men who are multimillionaires cry over a $50 loss because it was the straw that broke the camel's back. So give this number some serious thought, then stick to that number for the next 100 trades that you place. Now lastly, and this is something that I stumbled on from day one purely by accident, but it was something I was consciously doing from the very first day of my full-time trading career. And that was to measure and keep track of what you're doing to plot your performance. What is tracked and measured can be improved upon. So I give all my traders access to the tracking tools that I use to make sure that they keep on tip-top performance, as well as tracking my own performance. I want to make sure that I'm consistently performing as I would expect to perform. I also went as far to track my emotional state of mind early on in my career. Before, during and after each trade was placed, I would just write 1 or 2 words of how I was feeling. I would be confident or exhilarated or nervous. And what I noticed was that the trades that I was seemingly most confident with produced the most frequent and some of the bigger losses. And conversely, the ones that I was nervous over were some of the better setups, some of the bigger monetary rewards. And it doesn't seem obvious, but it was exactly the opposite to what you would expect. So what I was able to do was to slow down when I was confident or overconfident, and identify that I was skipping steps in my trading process. And it was something that I hadn't noticed because I was eager to place the trade. I was eager to put the trade on. I was going too fast. I felt confident that I was doing the right thing. And that was a warning sign that, slow down, follow the process, make sure that you're checking all the boxes. What I was also able to do was to actively seek out those better setups that my butterflies essentially identified, the nervousness identified. I could increase position size and take advantage of when I was feeling jitters essentially with those particular setups. They were the ones that I'd checked, double checked, triple checked, and I was still nervous because I'd done all my due diligence with my process. There was nothing left for me to do but place the trade. So if I didn't track what I was doing, I would never have known. So there you have it. They're my 4 big lessons that I've learned that have contributed to the success over the last 28 years of my trading journey. Firstly, have a plan, an objective that is attainable for you. Be consistent. The trade sets up, the trade goes on. Thirdly, trade small position size, sensible risk that allows you to sleep at night. And lastly, number 4, track everything that makes sense for you to track and monitor. What is measured can be improved upon. So, have you got it? Good. Now, if you've got questions and want to plug into a proven production line trading process, it's a simple, rule-based trading system that is proven, profitable, repeatable, and can take as little as 30 minutes a day, a few times per week. Let's start the conversation. Email me at phil@antivestor.com. I've always got time for serious traders, and what I do is not right for everyone, so at the very least I'll always point you off in the right direction. And if it does make sense, then we can hop on a call, talk a little bit further, and talk about your unique situation together. So right then, there's just enough time for me to end scene, roll the credits, fade to black as our hero exits stage left. I'll speak to you at the same time next week. So toodaloo, ta-ra, and a pip pip, and have a great week. Keep in mind that futures, options on futures, stocks and stock option trading involves a degree of risk that may not be suitable for all investors. Past performance is no guarantee of future performance. Antivestor provides educational information and does not provide financial advice.